fact that since the Fed and the ECB are going to keep rates low for long periods of time with huge amount of liquidity money supply there, then you could have FI starting to come into the domestic bond market and buying into the government bonds, and that would be positive. But we still don't know about that yet. So, but right now, all eyes are on the RBI to support the government borrowing. So, now going into Monday morning itself, the market is definitely waiting for something to happen over the weekend, but RBI has not come in yet with any kind of an announcement. It could happen, we never know. So we'll wait today, tomorrow, or maybe Monday morning before the market starts on any kind of announcement. But if it doesn't happen, clearly then the yields will open with a sharp gap upwards, right? But do we see the yields going up very sharply? No, because the markets will always expect the RBI to come. And there is also a huge amount of expectations of at least a 25 to 50 basis points rate cut by the RBI given inflation, right? So now the whole question of monetization of fiscal deficit starts. So what is monetization of fiscal deficit? Monetization of fiscal deficit is the printing of currency to support the government borrowing. Basically, if the government runs a budget deficit, then typically what they have till today, they have gone to the market to borrow to make up for the fiscal deficit. And many a times you have seen RBI also supporting the borrowing through what is it called open market purchases of bonds, right? So that is basically a monetization of fiscal deficit, but it's through the secondary market, right? And if it's through the secondary market, then at least there is some kind of a yield that is a market. It's the RBI takes in the bonds at yields determined by the market, not determined by the RBI. But when it goes, but when it takes the for example, when it takes the bonds directly from the government, then it doesn't go to the market at all, and then you could have nobody knows what's the correct yield the bond should trade. So the markets may trade maybe positive at some points of time, but then going forward, nobody knows what could happen. So we had the former RBI Governor Raghuram Rajan actually putting this piece out on LinkedIn about monetization of fiscal deficit, because it was a pressing topic and everybody was asking him the questions. And what he says is that clearly, I mean, it's not going to have any kind of an implication on the borrowing itself, on the government finances itself, because fiscal deficit is going to be high. So it's not going to reduce fiscal deficit, and it's also not going to impact the market in any sense, because you have a central bank that is stepping into by the bonds through either secondary market or primary market, right? But then what it raises a question is about the morality of it, because now this is a very critical situation in terms of you have a pandemic, and then you would need to do that. But then if but then even in the normal circumstances, if the government doesn't want to go to the market to access for the borrowings, then they might just lean upon the central bank, and the central bank, if it starts to monetize the deficit at all points of time, then it could lead to different kinds of repercussions, right? So what's going to happen now is, obviously, if RBI announces an OMO purchase of bonds, what we have seen the last time in 2008 when 10-year yields were at 5%, was when the government increased the borrowing and RBI announced an OMO purchase of bonds. The market, the yield still went up sharply, and that's largely because the RBI is buying the bonds at the market determined levels, and clearly the market didn't want to hold so much of bonds, right? So every auction now is going to be a challenge because we never know how the markets are going to react to every kind of auction, whether they want so much of supply. And this is also going to affect the state loan auctions, because the state SDLs are dependent on the 10-year, so where the 10-year is trading. And we have seen that this year in April itself, when SDL yields first auction was cut off, we saw about 135 basis points at the highest on the cutoff, and then the spreads came off sharply. But then the spreads could again rise sharply. going forward because of the because of the higher borrowing announcement, right? So just before we start the discussion on what can be the potential movement of the 10-year, I'll just take you through the RBI balance sheet, what happens in terms of when it starts to monetize the deficit of whatever it does on its balance sheet. So basically, um, uh, uh, we have just given you the RBI balance sheet in terms of what's happening. It's about maybe over $40 trillion, 40 trillion rupees, the size, and it's continuously going over the period of over a longer period. And if you see the assets and liabilities, the assets are largely foreign currency reserves, government bonds, right? And the liabilities are money supply, money notes in circulation, and then you have the reserves, CRR, and any other reserves or MSS, etc. We don't have any MSS outstanding at this point of time. So now what happens when the RBI, um, so uh, now what the Fed and ECB are doing when they buy government bonds is they're providing liquidity to the market. So basically, the liquidity they provide is called the monetary base. So that means, so when they announce a QE, they're going to say they're going to increase the balance sheet size, right? So same thing when RBI does a OM or purchase, or when they do when they buy foreign exchange, then what they do is they increase the monetary base. It's simply called creation of reserves. It's what they call it. What's it called is the creation of reserves. So uh, that's how it shows in the sense that the monetary base increases when it starts to buy either foreign currency or buy gold or buy government bonds. So it adds to so much of liquidity in the system. And similarly, when they sell foreign exchange or when they sell government bonds or any other asset, then it reduces the reserves. So we are giving you a few slides on how the whole effect of RBI operation works, and what does this particular creation of reserves do? Basically, it increases it's what we call a high-powered money, as 1 rupee of creation of reserves can lead to a can lead to what is it called increase in deposit, increase in the whole velocity of money through the money multiplier, right? So that means if monetary base increases, and then you have the whole system actually now it results in creation of more liquidity, given the money multiplier effect. So what could happen on the positive side, if the RBI is now going to buy in, this is going to support, for example, the excess of government bond borrowing over and above the budgeted levels, which is say around 4.2 trillion rupees. Then that means you have 4 trillion rupees of infusion of liquidity into the system. And already you've seen that RBI last year bought about $40 billion of FX, and that amounted about close to 3.3 trillion of rupees. So, and if you look at the current infusion of liquidity through LTROs and TLTROs, the total system liquidity itself is around 5 trillion plus rupees. And now you have another 4 trillion of coming in, and then you have close to 10 trillion of rupees floating in the system. And now the question, always the question of this fiscal deficit financing or increasing monetary base, is what is going to be the effect on inflation? So typically, what they say is that so much of liquidity leads to rise in asset prices, and that leads to various kinds of effects on inflation. Now, globally, what we have seen in the last 10 years, obviously, we've seen the US and the Eurozone, despite all that kind of, and Japan for almost 30 years now, despite that so much of liquidity, what we are seeing is there's no effect on inflation at all. And that's largely because of various factors. And given in this particular environment where there is absolutely no demand, and the commodity prices are low, then you still could see inflation staying down and the liquidity staying high in the system. But the question is, what happens going forward, right? So this, we are not going to expect this to remain like this for long periods of time. And if this is going to remain in the long periods of time, then you have a problem for economic growth as in developed countries. But in India, what we are seeing is the demand gets back to normal because we are both democratic, on a demographics basis, we are much younger. And second is we are still a growing economy, right? And so if this has an effect on demand and the supply is not there, then you could have inflation rising. And then obviously you have the government that is now increasing its deficit to a very large extent. That means its total stock of government outstanding debt has gone up, and that they have to service their interest, etc. The supply is going to get only higher, right? Not lower. So with all this, obviously, then what's going to happen is the bond yields are going to go up. So what we have seen in the last cycles, um, in the last cycles of in the last cycles of the 10-year government bond, is that every time it's gone to say around 5% or well below 6%, then it's tended to move up to 8%, 9% levels. So that's why the banks are really worried on what could happen if the yields start to go up, because if they're going to absorb so much of supply at below 6%, for example, and then yields go up to 7% next year, then what's going to happen to the whole supply of to the whole investment book? Now that's going to suffer, because yields are going, if they buy, especially the supplies at the longer end of the curve, and if they buy into this, and then what happens to the mark-to-market value of the portfolio? So, and then given this, the government bond, given the government bond yields are staying low this year, then anybody who tries to buy into higher yields, for example, AAA bonds, right, or tax-free bonds, which has already come down sharply, or any other bonds that is offering slightly higher yield than government bond, then they could also face a big hit on the books because of the fact that yields can trend up. But the question again to ask is, how long will this take to yields to trend up, and what do we do in the immediate term? Because you have no returns on deposits, you have no returns anywhere. So what do we do? So that's the question that is plaguing the markets at this point of time. Now, okay, just before I open this out for questions and discussions, so I'll just give give my view on what could be the moment of the 10-year bond. I think the 10-year bond yield can move up maybe 25, 30, or even 40 basis points if the RBI is not coming out with any kind of announcement. But the yields will always be capped, because markets will always expect an announcement, and also heavy rate cuts. The question is, once the announcement comes and the rate cuts happen, then what do the markets expect? They would expect more supply only. So in that sense, maybe the markets may not, the yields may not fall very sharply as well. So you then work onto a trend, and then every auction would determine what kind of a yield level that is acceptable to the market, right? And again, this is a demand supply based factor, and we would have to see going forward that what could be the potential yield movement. So this is very trying circumstances for the markets at this point of time, especially opening on Monday. We would have to see what kind of reaction the market takes to this kind of surprise announcement by the government. And then obviously we also have to wonder now, if there's so much of supply of government bonds, if the yields are low, so where can we invest in? So where is value in the market, right? So now with this brief note, I will ask anyone who has questions to raise their hands, or you can put it on the chat box, and then we can answer the questions. Ketan?
Hello. Yes, sir.
Yeah.
So we're waiting for some questions. So participants, if you have any question to ask, you can raise the hand, or you can put it in the chat box, and we'll call out to Arjun sir, and then he can answer to that. Hello.
Hello.
Yes, sir. We have a first question from a chat box from Subrat Mati, and he wants to ask like what kind of action we can see from RBI.
Yeah, so let's see what kind of action we can see from the RBI. The RBI can either come with an OMO announcement, right, which is the most I think, which is which is what is expected. So they will say that okay, we are going to buy 2 trillion worth of bonds in the next 2 months, right? And every week they'll announce an OMO auction schedule. Um, I think that is the most what is it called? That is what is most expected by the markets at this point of time. And but there is an outside expectations that the RBI may come and say that we will not do through the secondary market. We might just take through the primary market. But having said that, there are still some constitutional issues on that because in I think late 1990s, the RBI has changed the whole way that they're going to support the government. They were earlier actually doing this in terms of ad hoc support, but what now they did was at that point of time was to change the whole policy of only buying bonds in the secondary market, not supporting the government directly through bond purchases. They gave them WMA overdraft facilities, but not bond purchases. So the latter, which is what is it called, direct deficit monetization, is not widely expected at this point of time. What is expectations is more of an OMO purchase. And obviously, I think it might come with a rate cut as well, just to smoothen the market's anxiety over the borrowing. And then along with that, we also expect the government to announce a stimulus program. So these three can come very soon, I would guess. And then and now I can't give you a time frame, but it should come very, very early, as in it could be tomorrow, it could be as early as Monday, or it could be even later today. We're not very sure. So we'll have to wait and see what the RBI does.
The second question is from Prasanna Supriya. He wants to know what's the fiscal deficit expectation going forward, and can RBI do a special dividend transfer again to rein the FD?
Yes, I think fiscal deficit, I think from 3.5% of budget, it should double, right? Given the kind of pressure on the government bond. So maybe it could go up to 7% of GDP. And yes, and despite it will still go to 7% of GDP despite all the RBI transfers of dividends, etc. Because there is no revenue for the government. GST collections are not there. Tax collections are going to go down. And if the economy is going to grow at very anemic levels, that is 0.2% or 1%, as many agencies are forecast, then you're going to have a huge issue on terms of revenues. And really depends on the kind of revenue shortfall the government is facing. Right. So given this, I think with all this, I think the fiscal deficit should still double or even increase. We're not sure about that. But you can take it as a base case of doubling, unless the things improve going forward in the next few months.
The next question is like, can we expect some announcement from government also?
Sorry?
Can we expect some announcement from government also?
Yes, government will should be coming out with a stimulus package. Especially, I think they have been making noises on providing support to the MSMEs, etc., which is very much needed at this point of time. And so I think that should be coming out very soon, sooner rather than later. Like I said, I mean, it could come in extremely fast. I mean, it could be in the next 2-3 days as well.
Uh, Jenu Josh wants to ask a question, so I'll unmute him.
Sure.
Hello. Hi. Hi, sir. Good morning. Can you
Hi, morning.
hear me? Sir?
Yeah. Morning. Hi. Yeah, I can hear you.
Yeah. First of all, thank you so much for a wonderful presentation, sir. It was so nice.
Welcome.
And
Yes.
I just want to, we were all expecting there is too much of, there might be a widening of fiscal deficit, considering, the businesses are dull and the economy is degrowing.
Yeah.
So, in this scenario, do you feel now yesterday's announcement post which the 12 lakh crore worth of borrowing plan?
Yeah.
Do you feel any kind of rating downgrade in this scenario by foreign rating agencies? And
Uh,
how does it affect FPI's investment into Indian, India as a whole? How do you feel that?
Yeah, fair enough. Yeah. See, I think rating agencies have already sounded out the fiscal deficit. So they might just come in and say, right now it's stable. They might come in and say it's a negative implication, right? But I don't think they'll downgrade it because every economy in the world is a problem at this point of time. But even if they downgrade, see, the FIs are in India is a very, very different case altogether because the main factor is the government is not a big borrower abroad. So it really doesn't matter to the government what the rating is because it doesn't go and raise money in the bond market, uh, in the global bond market. Only the Indian corporates who raise the money, they face the any issues of rating downgrades, etc. But what we have observed in the global markets is that uh, Indian companies that have issued bonds typically trade at much better yields than the rating, what the rating suggests. So many of them trade at levels of many issuers that actually have higher ratings, right? That's because one is the lack of supply, and second is that India is seen as a more stable destination than any other place in the world for FII money. Obviously, when things go bad and the rupee starts to depreciate, they take the money out fast. But then we have seen these cycles happen. So the day the 1 year they take out the money, and the next year they come in with even more money. So it really depends on what the FIs would be looking to do. Is really depends on the kind of funding that is available in dollars. The second is the kind of liquidity, which is okay. The funding costs are very almost zero now, and liquidity is huge, okay, and it's going to stay there for long periods of time. So, and if the outlook for the US dollar turns to weak, and we have seen the US dollar starting to weaken a bit in this whole scenario, then and if there's some kind of a stability in emerging market currency values, then you could see even a higher search for yields. So what we have seen also globally in the last since the time the Fed said they would buy corporate bonds and junk bonds, etc. We have seen a huge amount of issuances by investment grade corporates and even junk bonds to some extent. We have seen spreads of Indian issuers coming down very sharply in the global markets, right? So you have CDS spreads of ICICI Bank and State Bank and Reliance coming down. Masala bond yields have come down. US dollar bond yields of issuers like NTPCs, Reliance have come down about 50, 60 basis points, right? So clearly, I think the markets are not really worried about the kind of uh, uh, really worried about the fiscal deficit or the rating downgrades because I think it's already been factored in what kind of pricing there is at whatever levels of yields that are available at this point of time. So it really has to be seen. So whether it's really going to affect the flows. But if you ask me, even if they do that, I don't think FIs are going to take money out. And I would rather say that they would look to come in at very attractive levels of yields if that happens, if yields rise. Yeah.
Okay. And anywhere in the world also in a negative returns, a negative yield
Yes.
scenario.
Absolutely. Yes. Yes.
Okay.
So
Okay.
this is the hope. Yeah. Now
Sure.
I'm seeing one
Okay.
question for PF trusts who are supposed to match EPF for returns of 8.65%. Do you still think they better wait till second half to invest in G-Secs or SDLs? Now, PFs are faced with a peculiar situation. I think anyway, PF rates have been reduced, so they don't have to really. Um, it's not 8.65. I think it's come down very sharply. I think the 8.65 is what maybe this year returns for this quarter. But having said that, obviously you cannot get 8.65%. Would they want to wait? Would they? But they have some regulatory uh, requirements, right? So they have to invest certain percentage in government bonds, certain percentage in corporate bonds, etc. And given this, now would they rather wait for the second half? I think they should wait for the next maybe one couple of months to see where the yields are settling down rather than doing anything or investing all the money at this point of time. And clearly, I mean, we don't know where the markets are going to go in the next few weeks, right? But then they'll have to anyway invest the surplus into the bonds. So they have no choice there. Uh, would they, and if this whole thing leads to some kind of an increase in spreads, credit spreads of AAA, PSU bonds, etc., then I think it makes a good opportunity to start investing in those kinds of spreads available. That's for the PFs. Um, yeah, one question is, what is the outlook for very long end of the yield curve, like 2060? Okay, so it's a very segmented spot. So we have seen that 2060 bond, the first, it was cut off at 790, and then it came down to 690. I think it's trading lower. But I think the curve can stay steep because it's going to what is it called, be volatile if the curve. But having said that, now this deal can turn sticky at some level because there will always be demand from PFs and LICs of the world to buy this bond. So it's a very segmented market, not very traders driven market. And if in this whole scenario of low rates, if around 697% or 720 is a very acceptable kind of rate for that kind of a maturity bond. Obviously, I mean, since they are held to maturity, they don't really worry about yield spiking up, going up and down. But yeah, I think this could be maybe offer some kind of a protection if it rises, in terms of the yield rises sharply in a knee-jerk reaction next week. But I don't see that happening too much. And if that happens, maybe there could be opportunities to buy into this kind of a bond at higher levels of yields.
So we have
yeah, sorry, Ketan, go ahead.
Question from Parthiv Bala. He want to ask a question. I unmute him.
Yeah, sir. Morning, sir. No, thanks
Morning.
for coming out and giving this important time.
You're welcome. Yes.
My question is two things. One is you see the amount of liquidity which gives a comfort level in the market. Ever since from last almost June onwards, 2019 June onwards, the liquidity is massively improved. And that's a comfort factor. And right now, this announcement yesterday, whether the liquidity will have no dry up, because most of the banks are pumping into GSEC only now. And with the yields moves up, one is how the liquidity positions are going to be. One, my question is. Second is, since the FIS FPI investments also is unlimited now, whether they will come in massively when the yields are move up sharply, whether they'll participate hugely. So I want to ask you these two questions. Thank you.
Right. Okay. So on the liquidity front, it will be very, very high. I don't think it will come down at all, because one is already the liquidity is very high. And second is, if the RBI is now coming to buy the bonds, they're going to add primary liquidity into the system. And what we also seen is that we have already seen a huge amount of volatility where both equity and debt has been sold by FIs. So from here, from these levels, further selling, I don't see envisage at this point of time, unless something very bad happens, right? And with all this, I think liquidity is going to be very, very high in the system. That's going to continue to remain very high. And so given that kind of a liquidity, I think the markets will start to, at some point of time, search for yields at all over the place. So, which could actually make the bond market a much more robust one than what it is now. The second is, if FIs, SPI, FIs, I think if they see the yields are at attractive levels, and if they see a long-term sustainability of the India's growth, then I think they can come in to buy into the yields at higher levels, and that's a very strong possibility as well. Okay. So trust this answers your question. I've seen a question with the TLTRO's liquidity absorption only partially successful. For the banks now have to actually decide on lending as the 1 month window comes to an end. Will this lead to credit growth now with another bad NPA cycle? No, actually, if you see the last credit growth number, it's about 7.8%. I'm not sure, unless it's a forced lending by the government. I think if the government asks banks to lend, they'll have to provide backstop in terms of guarantees. But I think the banks will be extremely cautious. They are very cautious. That's why they're not lending at all. And so with the 1 month cycle, I mean, the TLTROs are very targeted in terms of buying primary issuances or secondary issuances, and they've been very safe in lending to very large corporates or buying PSU bonds. They have not really gone down the rating curve, and even the mutual fund support TLTROs or failure, and clearly the banks are not very keen on buying lower rated bonds sold by mutual funds on redemptions, right? So this time around, I'm not seeing such kind of a large scale NPA. What if that happens? If NPA start to happen, actually it will happen because of prior loans, basically to retail that's holding up, rather than to the corporate loans that has anyway already been written off by most of the PSU banks. So this is a kind of effect I think we should see at this point of time. Okay, here's a question from Arvind R. On what basis the quantum of printing of money is determined, if there are any limit to it? Okay, now there is no basis, right? The Fed is printing some. The balance sheet size has just taken about a month to actually go up to almost 30% of GDP. So somebody was, some tweet had pointed out that Japan took about 30 years. The US has taken only about 45 days. So clearly, I mean, I think there is no real quantum, but then it's all a question of some kind of model that central banks run. Maybe RBI too will be having a model on what is the optimum amount of money printing that can be done without destabilizing long-term inflation expectations. And based on that, I think they would print the money. But having said that, these are very different times. I don't think you have seen a time like this in history as well. And given this, we don't know really what the central bank's limit can be, right? The idea is make sure that the economy doesn't fall off the cliff, and there's enough to stabilize the economy for it to grow going forward. But the question is, would this weaken the foundations itself? That's something that remains to be answered going forward. Why does Arun's asking a question? Why do you expect the announcement of the RBI not to have meaningful effect on bringing down yields? What was the primary example of this in the past? Yeah, so given that RBI will buy bonds, the OMO, now the OMO is determined by the market, and the market expects inflation to rise going forward. So they would rather be safe and bid at higher levels of yields in the auctions or buy in the secondary market, despite the fact that RBI is buying bonds. And so when RBI buys bonds, what it does is it frees up space for banks to actually bid in the auctions, right? Earlier, in 2008, we saw many auctions getting failed, and because the yields were very, and the RBI did not accept all the auction amounts as well, because the bids were very high in terms of yields, because the markets worry of the supply. So if that happens, then the RBI has to come in and aggressively buy the bonds in the OMO, and that helps to make sure that auctions go through smoothly rather than anything else. And the yields are obviously determined by the market. But here the RBI has again signaled its intention to keep yields down. They did Operation Twist when the yields had gone up sharply, especially the 10-year yields. So with that, they might still do that, do a lot of Operation Twist to keep the yields down. But the question is, how long are they going to do that? And if they're doing that continuously, then are the yields levels the optimal levels for any investor to buy? Because it's obviously being held by a central bank, and the central bank is not a market-determined player. So these are all questions that still need to be answered. Very difficult to give an answer now. So it really depends on the kind of risk appetite the investor has, and what kind of belief that an investor has in terms of where could long-term yields go going forward. I'm seeing a question from Gaurav Jain. What are the best case, base case, and worst case scenario for 10-year GSEC for a 3-month trading call? Now, this is the most difficult question to answer, but I think The best case is that yields can go down maybe to around 5.5 or slightly below at the in terms of if very aggressive OMOs and rate cuts happen. The worst case, it can go down to maybe about 6.5 levels if RBI just doesn't come in at all. And the neutral case can be the base case, as I said, can be a range between say 570 to 5.6 quarter at this point of time. But I mean, like it's just what I'm saying. I mean, it's uh, this what I would think it would happen. Clearly, the market can't really be going against what I say at all, right? But what you need to do is just look at the kind of discussions we have had today, and then take your own call on that. Right. Which category of debt funds would you recommend to invest in at this point of time, keeping in view 1 to 3 years time? Okay. Now here, I think if you're looking at a 3-year time horizon, I would actually, I wouldn't invest now, but definitely funds that have credit spreads that are pretty high and are very less expensive in terms of expense ratios you can look at. But right now, if you really ask me where you want to invest for a 1-year point of view, I think you're best off in very liquid short-term funds. Take the very much lower yields that come to you, but better not to take any kind of a risk to capital in terms of credit risk. But going forward, I think if the credit risk scenario starts to stabilize, and then definitely you can look at higher yielding funds, right? But having said that, now let me just give you what I believe. Okay, so if you take now the government bond yield curve, right? So we clearly know the government is going to come in. We clearly know RBI is going to come in to support the yields at this level. And we clearly know if the RBI is not going to come in, then the yields can go up very sharply, right? So we don't know what level is the right level, right? So given that, so it's an artificially held curve at this point of time. So then you go down to obviously state loans. Again, that also can be, that also is dependent on the 10-year. And that also becomes an artificially held curve at some point of time because the 10-year itself is an artificially held bond. So where is actually the markets determining the yields? One is obviously on the corporate bonds, and that's largely because there is no compulsion to buy and sell corporate bonds by the market. So corporate bond yields are reflective of, to some extent, are reflective of the fact that it's a market determined yield. And now if you go up down the rating, right? So there is we all know that there is absolutely no liquidity in the market, and so most of the if you take out AAA PSU bonds, most of the bonds are trading at well over 10% levels, or some of them 15%. And if you ask for bids on any offers now, it will come at 20, 25%. Come anywhere because nobody wants to buy. But then these are all market determined yields, right? And so in this sense, so the value clearly lies down the curve, right? But then having said that, you're still in a very highly credit risk averse period. So, but it does make sense to keep a strong watch on any good issuers that you think are solvent and would then stay firm and then grow going forward. If the yields are at pretty attractive levels, I think it's definitely worth a study. And then if it looks attractive, then you can definitely look to get into the higher levels of yields because the spreads can come down very sharply. And here at those levels, the spreads, it really doesn't matter where the government bond yield is, because even if the government bond yields can go up by 200 basis points, those yields won't come down, largely because they're already trading at very, very high levels of yields. Right. So there's one question, Vikram Dalal. RBI saving bonds are still offering 7.75% interest on their bonds. 2 questions. Why RBI is raising funds at this rate, and what are chances of RBI reducing interest rates in the future? Now, it's a good question. I think RBI wants to encourage savers, especially the retail savers, to invest in the bonds, long-term savings. Hence, they're keeping the bond rates at that level. And would the rates come down? Yes, because the government has reduced can come down because the government has already reduced the small savings rate across. So if only the RBI bonds can, if stands out, then the RBI may just reduce the rates. But I think they'll have to manage the expectations of small investors as well. And given that there is nothing available for small investors, they might just keep the rates at that level. What do you think about investment in long-term paper for tactical call? Yes, if yields spike. This is from Ravi Mishra. Yes, if yields spike next week and long-term yields like 2050, 60 bonds go up very sharply, then there could be trading place. But then they are still like illiquid. The bid-ask spreads can be wide. So it's better to wait to see some kind of if it's very sharp spike, maybe yes, you can start to get in slowly, just to take some risk. Obviously, it's a risky, it's a risk position, and you would be able to you would have to manage the risk before you want to do anything else. But yes, there are still opportunities available on spiking of yields, especially given the fact this time around that maybe you might not have inflation rising very sharply for a long period of time going forward. Okay, so EPFO reduced to 8.5 for 1920. Yeah, this is this year. But then after for 2021, I think it's reduced. It's reduced sharply. Yes, I mean for last year, if you have to pay out, I think I'm sure many of the PFs are still underfunded at this point of time, which has always been the case for most of the PFs. They continue to remain underfunded. Now I'm seeing this question from Vikram Dalal. What will be the total fiscal deficit considering central and state government? Now this could be the state's fiscal deficit around 4-5%, we were actually looking at about 12, maybe 13 to 14% of GDP, right? Center plus states, which could even go up to 15% if this about 5 to 6 or even equal, maybe about 13 to 15% on the outer side. And if everything stabilizes, maybe around 11 to 12%, 12 to 13%. Center plus states fiscal deficit. Sanya, will it impact equity markets? To some extent, I think more on a positive side than negative side, because there'll be a huge amount of liquidity if the RBI comes to buy in the bonds, and that liquidity has to go into risk assets at some point of time, given very low levels of yields. And if that happens, then equity markets can actually see attraction. And I would suspect that's what's happening globally, because nobody wants to buy US treasuries at 0.5%. Then you still have worries on junk bonds because the Fed is buying artificially. They're not going to buy every time. So only place where the central banks don't buy is the equity markets. And there, I think it's market driven. So at least there's some semblance of the investor having a choice on what to buy. And so to some extent, I think maybe that's one of the reasons why equity markets have rallied from lows and continuing to stay stable at from their low levels, right? Arvindar, with the quantum of liquidity globally, do you expect financial assets like equity and bonds to rally significantly? Not bonds, but equity possible, right? And bonds here would be higher yielding bonds, not the government bonds, because government bonds have already rallied. There's nothing much to buy from here in global markets. So there will always be a chase for spreads. And so with this chase for spreads, I think if there could be a rally. But having said that, would it happen right now? Because there's still uncertainty over when the lockdown restrictions, how long the effect of the pandemic will remain on the economy, how much more bankruptcies can happen, etc. It will be a slower process than fast process. Nobody will rush in to buy all this. but I think it could have, you could have drip down on spreads. And if you're able to identify right bonds or right stocks, then I think you're there in the money. This is my view. Like I said, so if um, anybody else has any view here, please feel free to add your views. Or if anybody has any further questions, please ask. Ketan, can you just check if any more questions are there or any I have missed out?
Yeah, one question is from Prasanna.
Yeah.
Any views on USD INR given infinite QE from US Fed and gold given the low interest rate globally?
Yes, gold have always been. I dislike gold, and yeah, actually only one point of time I got it right in that when it touched 1900, and he said it's going to come off very sharply. But then I've never said gold can be a great asset class. But yes, I mean, gold has a potential to rally, largely because if people are losing faith in currencies, and there is a lot of talk out there, right? The way the Fed and the US government is printing money. There is no growth in Japan. There is no growth in Europe, Eurozone, right? So if there is a loss of faith in currencies, then gold is a beneficiary. The Indian rupee, yes, I think it can. I think to some extent we are seeing a lot of risk at these levels, about 76, 77 levels, and it should stabilize and look to trend down from these levels, unless the India is taking a longer period of time to come out from the lockdown scenario than other global economies. So we have seen now many countries actually coming out of it slowly, easing restrictions. By June, they say they're going to resume many activities which they are closed. Even now, many have resumed activities. In India, it's still not very sure because key centers are still under lockdown conditions. So we don't know how far the supply chains can get disrupted, etc. But having said that, I think the rupee has seen its worst. Is at 77 when it went close to that or touched at one point of time. And I think it's going to trend, maybe stay in a range between 75, 77, or even trend down, depending on the kind of risk flows that come into the country. Right. Okay.
Yeah,
Any?
there's another question from Geno George, and he wants to know, like, will you please help me with the maximum quantum of securities RBI can buy?
Okay, so there is no maximum quantum of securities RBI can buy. They can buy limitless. But like I said, it all depends on what kind of models they have, which forecast that if they do so much, inflation can rise so much. So they have a 4% inflation target, etc. And maybe that can have an effect on the limit to which they can buy. But at this point of time, I think everything will be given more towards keeping yields down, interest rates down, helping the government, supporting the government borrowing program, and making sure the economy is not suffering too much. So it could mean a very high kind of a stimulus from the RBI in terms of buying bonds.
So we have another question from Subirja, and
Yes.
he was saying he want to know a product to invest for 1, 3, and 5 year horizon. You
Oh.
already answered for 1 year, so 3 and 5 years. Also, do you expect any major negative surprises on the NPS?
On the NPS, it could happen. Yes. Negative surprises could happen if the retail starts to falter in terms of payment. We would know this in the next 3 to 6 months, right? Because if you have wage cuts, you have job losses, etc., then people may not just want to service their loans. That's a problem. But having said that, what would be the best investments in a 3 to 5 year time frame? I think uh, uh, if you get the timing right, I mean, if you get enough stability in terms of in terms of credit stability, credit market stability, then I think the best investments at this point of time would be into higher yielding bonds, which are trading at, say, over 10, 11%, 12%, 15%, 20%, etc. But again, you would have to have a very strong view on the issuer as well as do your own due diligence and research before you invest in such bonds. And also, having said that, now just because perpetual bonds are offering 12-13%, I don't think you should do that. And largely because nobody knows how to price the perpetual bond, right? And we have seen that when wrong pricing happens, and it just gets written off, like the Yes Bank case. Now nobody wants that kind of a problem. So best to avoid perpetual bonds to traders or institutions who believe they can price it. If they want to know, if they think they know how to price it. But if the way the market is pricing yield to call, I think it's the worst kind of pricing that is available on a perpetual bond.
We don't have any
Yeah.
question like now.
Any further questions we don't have?
Yes.
Yeah.
We got one question from Arvind
Sure.
Amar. Like he was asking, like, do you foresee any credit risk on banks 81 bond?
Possible, especially weaker banks, private sector banks, weaker private sector banks, small banks, if they continue to see a huge amount of risk on their balance sheets due to NPAs, then possible, right? So would not write it off. But yeah, I mean, I would not write it off. Yeah.
So we are getting a couple of questions more.
Sure.
So can you share on your views on banking and PSU perpetual in the short term?
Like I said, I mean, perpetuals, I don't encourage anyone to buy because I believe the pricing is completely off. It's priced very, very naively at yield to call. It's not the way to price a bond. And we don't have enough pricing curves to price the bond correctly. Basically, it's an equity risk premium. And so given that, we really very difficult to say where the pricing should be. But having said that, I mean, if people think they can price the bond, if they have some other views, for example, if they believe that some Nat bank can come and actually call the bonds earlier and is trading at, say, 90 rupees or 95 rupees, then, but that's their own view. I think it's, for me, I mean, even if I was managing institution money, or I would best leave it alone. Yes. What is the next one, Ketan? What is the question?
The question. So the next question is from Prasanna.
Yeah.
He want to know, like, what is the amount of special dividend transfer possible based on last year Jalan recommendation?
I think RBI has already given a huge transfer, about 1.7 trillion last year, right? That was a one-time transfer. So here it'll have to be, it'll be really dependent on the revenues the RBI earns, right? And so in that sense, they might just transfer everything out, but that one-time dividend will not be there unless they rework their whole calculations. But I don't think that's going to happen at this point of time. So I don't see them going well over what they did last year. And I think they'll find it even difficult to achieve what kind of level they found last year as well. So yeah, so in that sense, I don't think the dividends really is going to have a great effect on government finances.
So we have a last question from Chaitanya Wala. Do you see the rates of SGL going down currently? Currently, we see them at 7.75 to 8 range.
SDLs, is it?
SGL.
SDLs have come down, right? The rates have come down sharply. The spreads have also come down. But once, I think we'll see on next week in the first auction after that, after this government bond borrowing announcement, where the cutoffs come. And depending on where the 10-year settles. So if you want to really ask me where the spreads will share, if it spikes up sharply, maybe it can go up to, say, 135, 150 basis points over the 10-year bond. And maybe it will settle down there. And if things improve, then maybe the spreads can come down to below 100 as well. So you have a spread range. I would rather give a spread range than an yield range. So you have a spread range of between maybe about 70, 80 basis points to 150 basis points, pretty wide. But we are in very volatile times. So it's not a very narrow spread range at this point of time.
We don't have any more questions, sir.
We don't have any more questions. Yeah. Okay, then I think thanks everyone for attending the call. one sec. Let me just check if there are any. Right. I think thanks everyone for attending the call, and please to give your feedback to us on the webinar, and we will continue to hold more and more such webinars going forward on very topical issues, which can help you take, especially in your in any kind of professional capacity, or in terms of both investing or advising, or in any other way, yeah, take better decisions, right? And the presentations and the recording will be sent to you. And yes, I mean, continue to follow INR bonds. Having said that, having mentioned the platform as well in terms of the kind of bond information, etc., a lot of it again going to be proprietary as well. And as you all know, our reports and all, while some of it is available open to all, most of it is for restricted view for members. We have a very robust online training program, and so those of you who are keen on improving knowledge in fixed income, they can come on to our training programs. And those of you who are very keen on receiving our reports, etc., you can subscribe to our to the INR bonds content. And yes, as I mentioned, we are very excited about the kind of offerings we have on the bond price discovery platform going forward. And that's really going to hopefully be a game changer for the whole bond market coming in the coming days. Thank you all for attending.